Yep, here we go. Okay. Well, thanks everyone for joining today. I'm going to get started in the interest of time, and I'm sure some people will still continue to join. I usually do my webinars recorded, pre-recorded, but I thought today was important to do this live so that we could have a bit more of a discussion and ask questions throughout, because this is pretty timely legislation, and there's not a lot of time to really interpret the results for everybody. We have, a short, and I think not even 10 weeks to really grasp what this means for personal and corporate financial planning and tax planning. So I thought it was important to do this and also to give all of you an opportunity to ask any questions that you might have. Now, that being said, I am not a CPA, as we know, so with the caveat that I'm not a CPA, and if there are specific questions that pertain to your financial scenario, that either we book a separate meeting to discuss that, or you also coordinate that with your CPA as well. And we'll keep the discussion a little bit more general, if possible, for today. I don't think we'll need the full hour. I just sort of allotted an hour for this discussion. But please, I would like to keep this relatively informal, as I do most of my webinars. So if you do have questions, again, just use the chat or the hand raise function on Zoom, and I'll be sure to attend to that. Okay, so without further ado, we'll get started. So the scope of what I'm going to be talking about today are some of the changes that were brought forth in the federal budget of last week. There were quite a few eyebrows raised at some of these changes, both on the personal side and on the corporate side of things. And so I thought it was important that we talk about what those mean. I've already spoken to a few clients who have had some misinterpretations of what's actually happening. So I think it's really important to clarify this and also to determine what that means for your own financial planning. So just in summary, I didn't summarize the entire budget here, but really just the specific tax changes that we're going to be talking about today. They've been talking about doing this for a long time. So if you're one of the clients that I've been working with for a number of years, we've been talking about the capital gains and what might happen to the capital gains inclusion rate now for a long time. And I'll talk about what that specific thing means, the inclusion rate, as we go through this webinar. But the changes have finally come to pass. And so what are they? On the personal side, right now, if you have capital gains that you're realizing, and by realizing what that means is if you're selling something for a gain, then you are taxed at what's called a 50% inclusion rate. So what that means is half of your gain is taxable and half of your gain is considered tax-free. And we've had this regime for quite a while now, and it has made capital gains our most tax-friendly source of investment income that we can generate. And a lot of people have profited from this. It's been pretty fantastic for those who are investing in, let's say, rental properties or anything with unrealized deferred capital gains over the years. So it's been pretty fantastic. But Tuesday's budget from last week has stated that as of June 25th, 2024, the inclusion rate, which is that 50% that we talked about, is going to rise from 1/2 to 2/3 on capital gains realized over $250,000 in one tax year per person. So if you are married, you and your spouse both will get a $250,000 allowance. But anything above $250,000 of taxable or of capital gains, in any tax year will now be taxed at 66.67% inclusion rate. So what that really means in plain English is that more of your gain is taxable to you now than has been allowed before. And that was intended to only impact the top 0.13% of Canadians. I think a lot more people are going to end up getting trapped in that if we have people who have rental properties, investment properties, cottages, anything of that nature where we have a larger asset with a potentially larger capital gain. Also individuals who are holding rental properties inside of a holding company. Now this is less tax advantageous than it was before. individuals who have large, let's say, company stock that they haven't realized capital gains on to date, that they've been holding for a really long time. There's a lot of potential implications to this legislation. So the personal side isn't fantastic, but for a lot of individuals, we can sort of plan around most of this in that we can hypothetically control how much we take in terms of capital gains in a particular tax year, aside from perhaps larger assets. But for corporations and trusts, the legislation is a little bit more punitive. So instead of it being that your first $250,000 is given, again, the same 50% inclusion rate, now every single dollar of capital gains that you earn inside of a corporation or a trust is taxed at a 66.67% inclusion rate. So that is incredibly problematic for a lot of individuals who are using their corporations to save for retirement. And this includes medical professionals, this includes consultants, this includes anyone who doesn't have a corporation for the purpose of selling the corporation. So really anyone that's using the corporation as another way to retain and defer taxes for retirement. These are pretty impactful. That last one, I would say, is probably getting the most attention from the tax and financial planning community because, and I'll talk about this a little bit later, it breaks something called tax integration. Tax integration is intended to provide fairness between personal and corporate taxation. So we're going to talk about what that means a little bit later when I go down into the corporate tax measures a little bit more. So as I mentioned, who's impacted by all this? Lots of different potential individuals, corporations, and trusts are impacted by this. So I think if you look at the list on the screen, you can see that probably more than 0.1% of people are going to potentially have issue with this and be impacted in one way, shape, or form. I don't know where they got their literature on who's going to essentially be impacted by this legislation, but I can guarantee you, I know a lot of people that would be definitely impacted by this who are average everyday Canadians and are not considered to be, the top 0.01%. So I think it's important when you're looking at your own financial planning to consider where this may be impactful and how might this potentially change what you might do going forward. What I would encourage anyone to do, though, is not to rush into anything because we don't want to be reactive. We want to be proactive in financial planning. So first of all, just examining what that impact can be, and then playing out the pros and the cons of doing something versus not doing something, and what are the long-term implications of both. And we can talk about that individually in our future meetings as well. So why are they doing this? Well, they've been saying they were going to do this for a long time. So doesn't come as a huge surprise, just kind of like, okay, it's here. Now, what does it mean? If anyone has read any of the, recent news on, our debt and what they're doing to repay all the debt that we accrued during COVID, they need money from somewhere, and their fiscal responsibility, let's just say, has not necessarily been top notch. So they have to get it from someone, and they're going to get it from the people that they want to do their fair share, which means that they're going to get it from the people that are entrepreneurial, people that are creating wealth, that are making wealth in the country. So I wanted to just take a step back and look at what does it look like today without the changes. So where are we starting from so that we can see where we're going? I'm using Ontario as the scapegoat, as usually people do in these presentations. So if you're not from Ontario, my sincere apologies. Since 2000 now, so it's been 24 years, we have had preferential tax treatment on capital gains. We've had an inclusion rate. So inclusion rate is the rate at which capital gains are added to your income of 50%. So half of your gain is taxable and half of it is not. And that applies to both individuals and corporations to date. But for most of the 1990s, the inclusion rate was actually 75%. So some people on this call might remember that if you were investing in the 90s, but it was a lot more punitive back in the day, and they changed it. So even though we are changing the inclusion rate today, I just wanted to add that caveat that it can absolutely change in the future as well. We always have to plan with the information that we have at hand, but knowing that we'll have to be adaptable to changes in the future. And that's what financial planning really is. So that being said, we don't want to make reactive changes, planning for something perhaps that might happen in a few decades, because we don't know where tax rates are going to be in a few decades and what might happen then. We just have to make our best assumptions. So if we look at the different types of income that we can generate from investments, specifically in Ontario, interest income at the top tax bracket in Ontario is going to be the worst in most cases, 53.53% in Ontario. At the top rate is what you pay on interest income sources. And that's things like GICs, interest income from bonds, high interest savings accounts, and that sort of thing. Eligible dividends are dividends that you get from public Canadian companies that issue dividends. And we get a special tax credit in Canada to incentivize us to invest in these companies. That brings down our overall rate of tax. And right now at the top rate in Ontario, we're sitting at around 40%, just under 40% on anyone who's receiving eligible dividends. And in fact, it can be a negative tax rate. So if you only earn eligible dividends and you earn, let's say, up to about $50,000, you actually have a negative tax rate on that because of the dividend tax credit that you can get. So it's pretty advantageous to invest in Canadian dividends at certain tax brackets. Ineligible dividends are dividends that you pay yourself from your small business or from your private corporation. They are paid out on earnings that have been taxed in the corporation under $500,000, which is called the small business deduction rate. So if you are a small business and you earn under $500,000 and you pay a very attractive low corporate income tax rate inside of your small business, when you take out an ineligible dividend from your company, you pay a higher rate of tax than you would if you were earning it from a public company. So you're paying around 47.7% on dividends at the top rate that you take out of your company. There are some dividend credits that you get back in the company when you do that to try to integrate the two tax systems. We won't get into the details of that today, but there is something that offsets some of that personal taxation and refunds money back to the corp. Lastly, capital gains. This has been our favorite source of income. So right now, if you earn capital gains personally, you're paying a top rate of approximately 26.5%. So by far, it is our most tax advantageous form of income. And we do a lot of planning to try and generate capital gains when and where possible, especially in non-registered accounts, where we can realize the best advantage of that. So that's sort of the way that it has been. So if we're looking at where it's going and where this increase is going to impact things, what we really want to do is reference back to this slide. Because I think what is missing in the literature that I have seen out there is that although it is going to be more punitive to realize capital gains, in certain cases, it is still going to be more tax advantageous. So even though it does not feel good to pay more taxes, and nobody likes to do that, everybody wants to pay their fair share of taxes, I think, for the most part. Capital gains in higher tax brackets will likely still be the most advantageous form of income personally, over interest income, over dividend income. So I think just to keep that into perspective, it's still good, just maybe not as good as it has been. So this is an example. This is from the Globe and Mail from the weekend. They've done a lot of talk about this. If anybody gets the Globe, you can see what they've been saying. Sorry, I think there's somebody that's added a question. Oh, no, never mind. This is a hypothetical $1 million of total income, which is not a normal situation for most people. But in this case, it's $500,000, let's say, of wage income and $500,000 in capital gains. Right now, somebody who earned $500,000 in wage income and $500,000 in capital gains would pay 26.8% overall. In the new scenario where we have an increase in our capital gains rate, now we're paying 35.7 on our capital gains. So you can see there's a significant difference in terms of what we're paying. What the government has been trying to say is that if you just earn $70,000 of regular salary right now, you're paying more tax than somebody who earns $1 million in wage income and capital gains as a percentage of total earnings. Not as a dollar value, but as a percentage. So what they are trying to equalize is they're saying it's not fair for somebody who earns $70,000 to pay a higher rate of tax than somebody who earns a lot more money than that and pays less as an overall rate of tax. So that's why they're increasing it. They're saying, you know, that's not fair. We need people who are making more money to pay more money. And they're not doing that on the marginal rate that we normally pay, which is already in Ontario at 53.53%. They're doing that now on capital gains. I wouldn't be surprised in the future if we keep seeing our marginal rates slowly bump up over time. But for now, they're going to go after something else that they haven't touched in a while to probably not anger the full population base. Does anyone have any questions on this before I go on? No? Okay. So this is their illustration on who they think this is going to impact. So they're saying, you know, the bottom 50th percentile of people mostly just earn wage income. So this is really not going to impact them. The top 0.1% earns a lot of their income from capital gains. So this is really what they're trying to point out that they're going after, is this sort of wedge of individuals. You can see this is all starting from essentially the 90th percentile and up. I don't know, again, where they got this information. I think on a regular basis, if someone is, I don't know, who's earning regular amounts of capital gains at that level, but perhaps that's what they're analyzing, there's going to be a lot of, you know, individuals like yourselves on the call who might have a property that you're going to sell in the future, or who might have shares of a company that you have been holding on to for 30 years that you're going to sell in the future. And this will impact you. So again, I'm not sure where they get the information, but this is what their proposal is based upon. I know that this is a little bit small. I'm going to try to make, I don't know if I can make this bigger. This is the result of the increase across 3 different provinces. So we have Alberta at the top, we have BC in the middle, and we have Ontario at the bottom. So this is an illustration for people who have personal real estate. If you have capital gains on investment properties, on cottage properties of certain amounts, this is going to illustrate for you what the difference in tax rates will be, or the difference in taxes payable will be under the old regime and the new regime. So for example, if we take a property that has, let's say, a $500,000 capital gain in Alberta, we would have paid $120,000 in taxes under the new regime, the old, and the new we're going to pay $140,000. So it's a $20,000 increase. Let's take the $1 million in BC. We would have paid $267,000 in capital gains tax, and now we're going to pay $334,000, which is a $67,000 increase. In Ontario, again, same sort of illustration as BC, we have very similar tax rates. So depending on the rate of taxation, the amount of capital gains that you're going to declare, this could impact you significantly in your forward planning. You can see the 250 number is there just for illustration, but anything up to 250, there should be no changes, right? We're still at that 50% inclusion rate for anything under $250,000. So there should be no difference in taxes payable there. There was a couple, I guess, positive changes that I'll just highlight that don't have anything to do with capital gains tax, but I wanted to include them to not have this entire presentation be very somber. The first is an increase to the RSP home buyers plan. So when I bought my first home, you could withdraw or loan $20,000 from yourself from the home buyers plan. They increased that a few years ago to $35,000 from the home buyers plan, and now it's $60,000. So that's a pretty significant increase from what it has been. So if you are for people who qualify for a first-time as a first-time home buyer, you can now access up to $120,000 as a tax-free loan from your RSP. They've also changed the payback period. as to when you need to start to repay that loan to be further out and more extended. So that gives a little bit more affordability when we include that with the FHSA account that was also offered up last year's budget to allow people to save in a tax deferred way towards that first home purchase. The second measure that I thought was interesting is they have a new automatic RESP enrollment. So if you have family members or anybody that you know is having a child this year or after this year is going to have children in the future, this could impact them. What the government is trying to do is help those individuals who perhaps just don't have the acumen or the means to open up an RESP. So this is usually going to be tailored towards lower income individuals. And they're going to offer, if they haven't enrolled in an RESP by age 4, they're going to do it for them automatically. And they're going to grant them the Canada Learning Bond, which is something that you have to qualify for as a low to mid income earner. So if you qualify as an eligible individual for that, then they're going to do that for you and start that process for you. So that was, a nice enhancement for lower income individuals. All right, before I get into the business side, are there any questions on the personal side, capital gains? Does anybody have any questions there? No? Okay. Businesses, I'm so sorry. Anybody on this call who has a business, which I think there are several, knowing my clients, this is going to hurt a little bit, assuming that everything goes as has been proposed, let's just say. So right now, the capital gains measures have been the same as personal, but they are going to change to be different. They're going to tax capital gains from $1 of realized capital gains at 66.7%. So we don't get that first $250,000 of exclusion at 50%. We are taxed from $1 of capital gains. That's the gift that we've been given this year. So that this means a lot of things, but there is more taxes to be paid corporately, and there is less available to withdraw as a tax-free capital dividend when we have profits from let's say a sale of a property, of a stock, of something that you hold inside of the company that will attract a capital gain. And so that just means that it's going to be more expensive to take money out of the company because we can only withdraw 33% of our profits on a tax-free basis as opposed to 50%, which is what we can do now. There's an example that I have illustrated on the screen, and hopefully it's not too small for you to see. I ran the numbers to compare the difference between a self-employed sole proprietor versus an incorporated individual in the same circumstance. Just to keep apples to apples, they have the exact same taxable income of $107,000 a year. And in both circumstances, they're going to sell a rental property. So one is owned personally on the self-employed side, one is owned corporately on the incorporated side. And in both cases, they're going to realize $250,000 of capital gains. So what happens? In this case, we've got taxable income of $107,000, and we've got a taxable capital gain personally at the 50% inclusion rate. So the taxable gain is half of 250, so 125,000, giving total taxable income to the self-employed individual of 232,000. Within the corporation, if this individual was incorporated, they would have income at the same $107,000 level, but their taxable capital gain would now be at the 66.67%, which is 166,000, which is a $41,000 increase in what's being added to taxable income. So you can see it went from 232 to 273. Corporate taxes, well, there's clearly none in the personal side, but we're going to pay about $11,770 on the income piece right here. So just on the $107,000, we're paying $11,770. In the corporate case, we're going to assume that we're going to dividend all of the money out of the corporation to keep things apples to apples to the personal side. So in this case, we're going to pay about $23,000 in total personal taxes. on the income itself. And we're also going to pay $7,500 into CPP. So just on the income side, we're going to pay $30,000 in taxes. So you can see between the corporate side and the personal side, there's not a lot of difference when it just talks about the income piece when we are excluding the capital gain piece. And that is showing where tax integration is working relatively well. The main difference in these cases is that we're not contributing to self-employment CPP in this case. Now, if we add the capital gains onto this, in the corporate scenario, we're paying $26,666 in capital gains taxes, or sorry, in taxes inside the company. And then we're going to be paying an extra $61,000 to get the money out of the company that cannot come out tax-free. So the total impact of realizing the capital gain on a property sale inside of the company is that we're now going to pay in total about, call it $88,000 in taxes just on the capital gain. And when we add that to the taxes that we're paying on income, we're paying about $117,000 in total taxes. When we look at the capital gain on the personal side, we're paying $48,000 on the capital gain, and so our total tax burden is $79,000. So the net impact is that we're now penalized. We're now paying $37,000 more if we are incorporated and realizing a capital gain than if we were just to do this personally. So I know this is a lot of math and a lot of numbers, but it's really trying to show you that the net impact is having capital gains in the corporation breaks tax integration. It breaks the fairness regime that they have been talking about for so long. They have been trying to equate that if you're doing something in the corporation and if you're doing something personally, that it should be the same result. It is no longer the same result. It is now disadvantageous to the business owner. It's not fair to the business owner. I have read some literature out there. Somebody has made a valid point, which is that you still get to benefit from tax deferral if you're earning money inside of a company. So we're still paying 12.2% on our active business income, and we're still able to defer the taxes that we pay on that net income. So if we're earning $100,000 inside of a company in profit in active business income, we're netting about, say, $87,200. We then get to invest, let's say, that $87,000 in the company and grow that on a deferred basis until we realize that capital gain. Compare that to personally, if we had earned that same $100,000 personally, maybe we would be only left with $70,000 or so to be invested. So we're able to keep a little bit more to be invested inside of the company to begin with that we wouldn't have if we were doing it personally. So I don't want to forget that aspect of it, which is that we are still benefiting from the active business income tax rate inside of the company that is given to all of us at income earned under $500,000. So even though integration, when we take money from passive income, is broken, we still have that tax deferral advantage, which is there now, yes, is still there in the future. So the government is just saying, well, it's been great. You still get to, write off your active business income at a low rate, but anything that you're going to do passively that mimics an investment is now going to be treated differently. So in essence, the purpose that a lot of people have, companies for is, limiting liability, is the tax benefits of what you're able to get on your active business income and profits. But the advantages on the investment side are really not there. To be honest, they're pretty minimal at this point. So it just really begs the question, what do we then do with the profits that we're generating inside the business? How do we approach that going forward? What's the best route? Because we're still able to benefit from deferral. Do we approach things in the same way that we have been, or do we change what we've been doing? What makes the most sense? And that's what we have to examine. So yes, there is unfairness for people that are business owners. Integration is broken. This can disrupt a lot of people's existing plans that they have put in place at a different tax regime. It does disincentivize people to invest, absolutely, which I'm sure you've probably seen literature on. It also puts more reliance on personal plans. So it gives a bit more credence to strategies that involve perhaps taking out more salary, maximizing your RSP, perhaps saving forward to an individual pension plan or an IPP program, and making sure that you're maximizing your CPP allowances as a business owner. So there can be some shift in strategy if your corporate strategy to date has been very heavy on retaining as much as you can in your company and perhaps just taking out a notional amount of dividends under salary. It's worth discussing with your CPA to see if that still makes sense under this new regime, or with any of us on the call, Vicky and Justine and I should say. That being said, they did give us a little bit of corporate relief. This doesn't really impact anybody who has a personal services corporation, a professional corporation, or anything of that nature. It really incentivizes those who are going to sell their company in the future for a profit and who were going to have a gain on the value of their shares. This is where they've introduced a little bit of relief. I would say that this is sort of trying to make the pill a little less hard to swallow on the capital gain side of things inside of companies. But anybody who's selling their company, they're increasing what's called the lifetime capital gains exemption from just over $1 million to $1.25 million for anyone that sells their company after June 24th of this year. So you get a little bit of a increased tax sheltering on the value of your shares if you qualify for the lifetime capital gains exemption, that is. The second incentive that they have given is that they will, on top of the capital gains exemption, give entrepreneurs an additional $2 million, which is to be phased in over 10 years at, let's say, a preferred inclusion rate on the sale of their shares. So if you're going to sell your company and let's say it's worth $5 million, you get 1.25 million captured at a 0% inclusion rate, which is your lifetime capital gains exemption. And then you get another $2 million that's given a preferred inclusion rate of 1/3. So that is something. It's better than nothing. But it will really not capture those who are not planning on selling their company and who are using their company more as a retained earnings vehicle, which has been a lot of the planning for consultants, entrepreneurs, professionals, etc. Does anyone have any questions on that, on any of the corporate stuff? No one? Everyone good there? So what can you do?
Andrea,
Yep.
I had a quick question. I'm barely following it, most of this, but really appreciating it. Just the little piece about the rate increase. I thought it was for over 250,000. But those examples were under 250,000. Is that I'm missing how that works?
Yeah, so it's from $1 inside the corporation. It's over 250,000 personally. So if you have capital gains that you're going to realize and you own that asset personally, then it's capital gains over 250,000.
Okay.
But if you have any capital gains in a holding company or in an operating company that you're realizing inside of that company, you don't get that first 250,000 at the lower rate.
Okay, that makes sense.
Does that make sense? No problem.
Thank you.
Okay, so what can you do? It really depends on the circumstances, but I would say just if there's nothing that you were going to do anyway. So what I mean is if everything was hunky-dory and you weren't planning on really disposing or selling of any major assets in the short term, then I wouldn't hurry to do something just for the sake of doing something. We don't know exactly what's going to end up passing yet. There could be changes or amendments or suggestions made that will inevitably change what happens. So if there's nothing that's super pertinent or urgent that you need to do, then maybe just wait it out and see. But if you do have things or assets that you were going to sell anyway, or gains that you want to take personally, perhaps consider, does it make sense to do that before June 24th? So that could be, you know, shares of companies that you own personally that you want to sell, let's say on the stock market. That could be rental properties that you were going to dispose of regardless, that you don't want to keep owning. Anything that has a significant capital gain that you might want to consider. As well in the corporation, if you've got retained earnings inside of the company that are invested and you've got unrealized capital gains, perhaps it's worth exploring whether you crystallize and trigger those gains before June 24th and take out your capital dividend account allowance before that date and reinvest thereafter, so you can kind of reset the clock. There is a bit of a, does that make sense? Because when you're doing that, you're triggering a tax bill for yourself. So you have to determine, does that make sense? I think if you were going to do it anyway, maybe it does. But if you weren't going to do it and that's not something to consider, then let's run the math. Let's not automatically jump to selling the assets. Revisiting your corporate strategy. So if your strategy again has been, I'm going to take out, let's say, just dividends or a marginal amount from the company and leave the rest in there to grow as retained earnings, maybe that strategy needs to just be re-examined to see if it still makes sense. And maybe we need to shift it a little bit to be, you know, less advantageous inside the company because we're going to have a less preferred tax treatment. Rebalancing. So this is sort of a general financial planning tidbit, is if you do have non-registered investments that you own personally and you don't sort of create this capital gains bloat, more frequent rebalancing can perhaps lead to avoiding that future 66.67% on the sale of an asset. Now, that being said, it's the same argument. You're still going to then have to pay the taxes instead of deferring the taxes. So we have a calculator that we were given by one of the accounting firms that can help us to determine whether or not deferring or realizing that gain is advantageous over certain time horizons. So if you want to get access to that calculator, just send me an email, or we can discuss it on a future call or with one of the planners that you work with. That being said, there's probably a lot more here that can be potentially considered or done. But if you were going to implement something new, like let's say purchase a large asset inside of a holding company, maybe hold off for the moment until you really examine if that's the best strategy at this time frame going forward. There's one more little wrinkle before we sort of get to the end of this, is don't forget about the alternative minimum tax. So this is really getting into the weeds a little bit, but basically we have this lovely thing called alternative minimum tax, which is a personal tax, a tax measure that recalculates the amount of tax that you might owe. And usually this doesn't impact people unless they've claimed some sort of preferred tax deduction. So if you've realized a large capital gain, you get the 50% deduction or inclusion rate on that capital gain, which can lead to a higher amount of taxes being paid if AMT is applied against your income. And this is calculated, and if it's applied to you, then it's possible that you could actually recoup some of that tax in future years, but you do have to pay it in the year in which you might be assessed AMT. Now, as a interesting note, AMT rules changed as of January 1st of this year and are more punitive. The rate of tax on AMT has gone up to 20.5% from 15%. The inclusion rate has gone up to include 100% of capital gains under the AMT regime and 80% for employee stock option benefits. So basically, all of that being said, what does it mean? If you go to rush and trigger a bunch of capital gains to avoid the new inclusion rate personally or at 66.67%, you might trigger AMT. So this is potentially a very smart tax trap that the government has laid out in front of us to walk into, to recoup a whole bunch of tax dollars under both the new, to recoup or to get tax dollars under the existing capital gains rate with AMT applied against it, and then also AMT applied against anything that might be triggered thereafter as people hurried to realize capital gains this year. So that could lead to the government getting a nice little windfall in a way on AMT that they might not have had otherwise if people weren't rushing to sell things to avoid the new inclusion rate. So that's why it's always important to consider and speak with your CPA. Hey, if I were to do this, am I going to trigger AMT? What are the net tax consequences for me going to be? It's not just capital gains. So this is all, to be said, very complicated and really important to consult with your tax professional before actually doing anything of significant size, because you could be triggering additional taxes for yourself as seen here. So final thoughts. It might still be best to just keep deferring if you weren't planning on selling anything. So although it's not ideal, if we've already been running with a long-term plan, it might be best to just keep going with that and keep deferring. That might still be an option for you in your planning. And don't let the tax tail wag the investment dog. So in a lot of cases, it's really tempting to make changes because of a change of some sort of regime, but you want to let your planning lead the way and not let CRA lead the way for you. So if you weren't planning on doing something, or if you have a long-term game plan in place for yourself and for your investments and your assets, that should be what leads your decision making, unless there is a very, very significant difference in doing it now and realizing the gains now. So all that being said, make sure that you talk to somebody ASAP. It's going to be difficult because all CPAs are very busy right now because it's tax season. So, they have put this in at a very interesting time when they know that CPAs are very busy to begin with, and that the changes are coming down the pipeline very soon. Any other questions? Okay, so before we go, just a reminder, please just plan things out before you do anything. Planning is all about being proactive and not being reactive. So, reach out to us, reach out to your CPAs, and really think about what your long-term goals are for your own wealth creation before making any sudden moves, let's just say. But thank you so much for your attendance, and have a wonderful rest of your day.